Hi, welcome to White Gem Capital. This is Baron Kimmel. I'm going to show you a continuation on the gap fade strategy and how you can apply this probably to about any stock, and just kind of show you some additional analysis maybe you could use to improve your own trading. This is a proprietary strategy that we use, but it's been modified from Crowder and Altucher. So I first take the data of SPY, and I go back to 1990. This is just the daily data. It's not intraday data. So I take this and I can see that this SPY has been scaled up or scaled back when it was in 1990 because the volume is 0, so it doesn't make any sense. So I'm assuming that this index didn't exist back then, and since it's just tracking the SPX, or mostly it tracks the SPX or the market, we're using this. Now I'm just going through some of the data and I'm just seeing if the criteria is met, where a gap up is filled, gap down is filled, did a gap occur, and then if a gap up occurred, was it filled, or if a gap down it occurred, does that mean it was filled? I also discern the range from the open, so because that's when the trade is executed. I'm more concerned about the risk that I'm using in this strategy to the implied open. Now Crowder, he didn't go through all this statistics in detail, but I'm showing it to you and improving on it because he kind of left it as incomplete, and so I'm taking an idea, modifying it, see if I can add it to the portfolio and make money from this idea. That's the ultimate goal of this. So I'm looking at this and I say, okay, well, did a gap up occur? What was the range of that gap? And also the same with the gap down and no gap, and all trades basically, or just any trades. And also something today I did, and I noticed another correlation or pivot you could use with the data structure is that, so you have a percent change on open, and then you have a percent change in high and percent change in low. Basically what I'm trying to say is you have where the stock is actually you could have a significant gap up, but it's gapped up significantly because the ATR, the volatility in the market, is high, so is therefore gapped up above its previous day highs or previous day open significantly. So kind of like today on August 18th, the markets had a previous day on Friday had like a doji pattern, but actually had a significant gap up of about 0.5%, and a low, and sort of we're in a low volatility environment, so I would say I'd be a gap significant, and say, okay, I'm going to look at the percent change from the high, and then I can say, okay, what's the percent change from the low? So I can take the daily low and say, what was the max low? So you can tell, like on Friday here, because we're on the we can go over here, we're on the 15th of August. We can see that actually it went max down to 0.74%, and it also went up 0.45%. So there's a lot of range that can happen within the market itself. So one key to the strategy is, how do you enter the trade? We're trying to figure out the secret of how we can enter the trade, manage the risk without getting stopped out, or basically try to turn the odds in our favor a little more in this trade strategy, rather than just blindly entering on the open. Now that could work, but as I'm going to show you, the risk to get stopped out is high. So I really like that futures traders viewpoint on using the ATR movement, and I'm not super fan of ATR movements because it's relative to the stock itself. It was originally used in commodities because they were more volatile. They have ATR range, and as you can tell, if we go back to 1990, the ATR, the SPY is $24, so it's significantly lower than where it is today. So I take the maximum of these three values. You can read up on ATR if you want, and what I do is I take a 5-day average of these values leading into that particular day. So I say, okay, what's the ATR value? So I have a known determinant ATR value. I also have a percent, so that translates into a percent gap, because I need to translate this into 1999 years. The ATR itself is probably going to be useless because it's not going to be able to scale back to the data set I have, which is about 6,000 rows. And then I say, okay, here's just some additional duplicate fields where I say, well, did a gap up occur or was a gap down fill, and I just say, okay, I want a 1 or a 0 or 1 or a blank there. So here we go. So now we can, this is the data set I've included with the post, this post which describes the sample strategy which WhiteGem uses. And we're going to modify and improve it a little bit and try to understand a little more and help define the risk a little bit more. So 30, what is this trying to say? We have out of the whole 6,000, this matches the total data set. That value is true. And I say, well, does a gap occur? Yes. Or a gap occur? Does a gap occur down? No. And I say, what is this saying? It's saying that 1/3 of the time, or 1/3 of all trading days, a gap occurs of some form or another. Now with Croder, what I noticed that he was doing is he believes in only entering this gap strategy if you reach a market extreme, which depends on an RSI value. So he wants to enter the market when the RSI is either extremely overbought or sold. Again, he's trying to shift the odds in his favor. But I'm just saying, regardless of how the market is and all those other variables that I could care less about, because I want to say the chance for the gap fill is very high. I want to say, well, regardless of 1/3 of all trading days. So say you have 3 trading days in a row, it's 0.33 times 3. So it could be pretty rare that you have 3 trading days in a row, but to have 2 or 3 or 4 maybe in a row is not going to be super uncommon. Now I break down the data a little more into the actual gap up, gap down, and no gap, and all the trades. And I can take a look and I say, okay, with all gap, there was more gap ups than gap downs. So the market is oftentimes moving higher, and this is something you would expect because like the SPY was at $24 and now it's at $194, right? We can also see the max range up and down and the minimum range up and down, and I look at the average. So I mark it in red because in a gap up play, we're actually shorting via buying puts, and this means that the move up on average is how bad of a move on average. So this tells me that the move on average up, if I wanted to sort of leg into the trade, regardless of whether any type of range up, is actually 0.5% from the open, which can be kind of significant. And again, you could break this data down by year. So say you only want to use the last 5 years because you feel that data is more relevant for current market conditions. But I want to use the whole data set because I want to be able to trade this in any market regardless, even if we enter a high volatility environment. And I'm going to explain that in a second too, of the trades we avoid, expanding on the futures guys trader using the ATR movements. I apologize if this strategy is a little advanced, but it's how you make money. Range down is, so I'm looking here, so the range down is actually marked in green because I'm buying that put and I'm saying, okay, well, that's sort of the maximum range down on average of how I can make money within this this category. And so with the range up, you can see that's pretty high. It's 1% from the open. So say you have a gap down, on average you can have 1%, and you can see the max is actually 10%. There was one day that the market had a gap down and then moved up 10%. So you could tell if you short, you can tell there is a lot of, again, we're trying to, there's also, you can see the max down range too. When I buy a gap up, I could easily hold this for a jackpot situation of a minus 8% move, but that's the maximum you're going to get any one day. So it'd be like a market crash of some kind from the gap. So it could be, the total move could be higher. So also on the no gap, what's the average move? It's 0.6, and then it's 0.6 down. Basically about even, almost a coin flip. What does that mean? I thought this was interesting, is that basically when the market opens with no gap, you have almost a coin flip chance of saying if the market is going to go one way or the other. So this is a very good warning sign to day traders not to trade no gap days, because the odds of you actually, unless you think there's a market moving event, if you're just blindly trading every day out, you think you're going to jump in with no premise to the market, you have a coin flip chance roughly of making money. And then here's all the data, and then you see it's 0.6, and point average is like, actually if you go long the market, it says on average you're going to have the range down intraday on average is going to be lower than this. So you can see here's some I saw called the average difference, which is sort of the max range, and you can tell on the up days there's less volatility than down days. And you can see another interesting fact that the gap up days match the gap down days, which I think is interesting, but they're still lower than all the trading combined, as you would expect that, because this is including these averages plus the gap down. And you can tell how much is the volatility difference between a gap down day and a gap up day, or a no gap day, because they're the same really. Well, the difference is 51%. And I actually do something called a risk reward here, and I say, you know, what's the average risk to reward ratio of buying on either a gap up or a gap down day? Which one do you have on average more favorability? What's your odds more favorable to win on either a gap up or gap down day? And with this, the absolute value changes. I take the absolute value of these two numbers, but since this one's in green, this is my profit. Same with this one, so I have to invert them to get this value. And what it's trying to say is, you know, on gap down days, I have more advantage. Actually, on gap up days, I have more of an advantage than gap down days, because the range down on average on a gap up day is 50% higher. So buying puts is more profitable than buying calls, but we're going to analyze this a little bit more. And here's another thing, just something interesting, and we're going to expand. I don't have this data filled out because we don't need to, because we're going to go into a deeper table. But I say, what's the average of a percent gap ATR to gap fill true? So, and then I would say, well, a gap fill false. So what is this saying for a gap up? And I say, what is the average ATR move on, so the market is gapping up, and I want to know the ATR move that's happening on a percentage basis relative to the gap. And this is saying that to actually win in the trade, the further the market, as you would expect, the further the market gaps up, the harder it is for that gap to get filled. And that's what it's trying to say, is there is a logic to the momentum. So if I have a false value, means on average the market is gapped up a half an ATR move. And this is what the futures trader was trying to tell you in his video. If you watched it, he said if you go up to between a half an ATR move to 1 full point, you would actually only target half the gap fill. So again, you're not completing the full gap fill, you're only completing half the gap fill. And we're going to look at today's example, but let's go into the real nitty gritty here, and then I'm going to expand probably on this in a later video. Right here is the, let's look at the, this is just the gap up situation. Actually, there is the gap down right there. And it's the same information. Basically, the gap downs have more severe gap downs, because the ATR move is a relative number, what I consider a percent move, up or down. So here we go, and I can see like I have my winning percent, and then I see a losing percentage start to trail off here, and you can see the sample size. Here's the total of trades that fit within this ATR criteria. Percent ATR criteria, and this is over here. I'll go back. Actually, we're looking at the same number, so I want to go to the filled value, where I'm looking at an if statement, and I'm looking at the range. So here's the gap to ATR, and I'm saying the gap must be filled, and I want to see what the gap, because I'm looking at the gap filled is true and the gap filled is false to get a total count so I can get the winning percentage in the trade. And this is pretty basic stuff if you think about it. It's not as complicated as you think it is. What it's trying to say is the closer we are to the market gaps up, this is where the market's gapping up, I'm buying a put or shorting the market or selling futures. All these are the same thing within this SPY. What happened is I have a 97% chance to win. High probability that gap's going to get filled. But remember, the average range up over here, if you just look at winning percentage, yeah, you're going to have a high win percentage. What's the average risk you have to take to get this basically 5%, 0.05% move to fill the gap? You have to take a lot of risk to get that gap fill, because the average range up is a 0.5%. That's if you're going to win. And if you're not going to win, you're going to eat a percentage move, which means you're just going to get stopped out. So if you enter in on a gap fill where it's probably within the first 3 tiers right off the open, you're going to have even though you have a high odd of winning, and this is what you should take away from this video, is that even though I have a high probability of winning, let's increase the odds so I don't enter in this trade right off the open, or I can tranche into it. If I do feel like, okay, I think this is going to move down, because the risk reward is just not high enough. His other criteria, the futures trader said the Dow must gap up 20 points at a minimum for you to enter the trade. So we're entering all these conditions and criteria to improve the odds, and so you have less and less risk in the trade. And this is something I figured out this morning, and it's just something interesting that we can take away from this. What is the average gap up percent from the previous day high? So what's the true percent change, and how can I get this? So on these low ones, look at this. When I get filled, the average change to the high is almost a full percentage point. And this might seem really unusual for a lot of traders that have been trading for the past few years, because market volatility has been so low. But what is it trying to tell you? It says the market is usually a lot more volatile than what it is recently, because volatility is being suppressed for some reason, which we can go into another video about, but there's a macro reason for this. And we can say also, I can wait till the actual percentage change on day is this to actually cover, if I wanted to maximize it and not just play for the pure gap fill. But as soon as you start doing that, you create a more your trade is more arbitrary. And here is that with the if it's not filled condition, I can say, okay, what is the percent odds on me winning here if I'm not filled? Well, the market will open up actually lower than on average. This is a sample size of one. This is only on 4 trades, so of its sample size, right? Because that's what we're drawing from. So it's very limited sample size. But what it is saying, it says the market could open lower and you still lose. But you have such a high win percentage that it's just more interesting takeaway you should take is that the market's going to move up a whole percent. So here's the idea. Say the market gaps up and doesn't fill the gap like it has today on August 18th, and the market moves up almost a full percentage point, or 0.9% on average, and has not filled the gap, which has a 97% chance to be filled. You should buy that put right there, that in the money put, or you could short the SPY, or you could sell the future and hope for that chance that you're going to get that gap fill, because the odds of you winning are incredibly high in this particular tranche where the market is gapped open within this range. So we have to what I like to do, what I'm doing is I refer to this table, or I'm using this table to develop the trading system and to activate and forward test this system. So here we go. Let's let's take a look at the calls. And what I noticed here is when the further the market gaps up, what is this telling us? I marked this in red to make it easy, and this isn't in the post, so you could only find this information in the video here. What it's saying is that what I'm saying is the odds become more of a coin flip, or just below average odds to be filled, of me actually getting that full gap fill. And that makes sense, right? Because the market's gapping up higher, it's going to be harder for me to get that gap fill. So let's take a look and then basically what the futures trader said, and look at the sample size here. He said if, and this sort of confirms what he was saying, he says if there's a 1 ATR move, I mean say the ATR range was normally 1 point, or today it's around 2 points. Say if the market gaps down, SPY gaps down 2 points, which would be the 100% ATR move on a 5-day average. What it would do is we were saying, okay, we don't want to trade that. The market's just too volatile for us to trade anything, and so we just ignore it. And the sample size is very small, so we're ignoring, in this case, the total here, we're ignoring just 21 trades, out of, you can see up here, the gap up plays, we're ignoring the out of 2,000, so very small percent of trades. But it's another key indicator to say, okay, we're ignoring this. But most gaps, you're going to play them. So here's the gap downs, and you can see they're much more profitable. We can actually we want to trade this as much as possible, maybe except for this one. This is only has a 50% win chance. But the reason why I want to play it is look at the gap up change from the range not being filled. But you have a 1.4% gap move up, and then look at, you have a 2% there. So let's take a look at some of the lower tiers where the gaps are less severe though. So again, we have very high win percentages, 70, 90, win percentages. Again, we know we're excluding the extremes, but you want to basically, what is this trying to say? I told you before that playing the calls typically has less risk reward here than playing the puts. And what is that trying to say? Is say, well, we want to play, and what it's saying is it's more volatile, and we can see that when the market gaps down, it's like human nature is going to sell these gaps down because people get scared. And what happens is the market will continue to push down beyond the open. And even though that's true, you still want to buy that, because that gap has a very high odd for a day trader to get filled. Now if you're trading beyond day trader, you're probably not watching this video, and because you're not going to be able to easily move in and out positions. Even the futures market is very, very liquid, so this is a very, very scalable strategy. This is just something to consider, that actually buying this buying the dips or buying the crash is much more profitable than you think. But you do have a considerable risk, because you can see the say the range down, the gap is not filled. This could move in this tranche over here. This is if you have a crash, like a 2% on average non-gap filled. But look at some of the range down, look at the exact opposite. And this is a very small sample size for this tranche. But it's saying, like, if you have a gap down, but it gives you a frame of reference as well. If this exceeds my little range down average, I can stop myself out real quick before I eat this massive loss. And again, this can act as a framework to help modify your stops and targets beyond just the Crowder 10% range. And that's what this is improving on. This is saying, okay, we can also tranche into it. So say I want to enter in at the open, I could also tranche into it at one of these extremes on the day. Or if I'm in one of the lower tiers, or what he would consider to be under or overbought situation, I could tranche in, or I could actually enter the trade in at a higher price point, or a higher price point for a buying a put or a gap up, or a lower price point on a gap down, buying that call at a lower price. Because you can see the range down, even in the lower tranches, is still minus a 0.5% move from the open. So it means the market will gap down and then has an ability to move lower. What I personally notice is recently is these gaps mostly get filled quite quickly in the morning. But that's not to say that there couldn't be a late day sell-off. And I think all that information, day trader, the intraday data is mostly irrelevant for this because I'm just looking at the absolute going back. There was no decimalization before, the year 2000 almost, so some of the data that you're pulling from can be changed. But here's some more information, where we can do this. Now, the next thing I will do personally with this data set is I will develop a more intense pivot related to, I'll try to see if I can find additional patterns, especially where you have these lower tiers, to say, okay, well, what is the percent gap down? I'm saying, okay, what's the percent gap down? And then my probability of winning. So I can say, what's the average percent high? But not only that, where I have it in this tier, but I want to be able to see an additional pivot to not just this. I want to see it to this range and to this percent high. And at the end of the data here, you can see I have just a win percentage. So I have an 80% chance to win with this 20% chance to win. So gaps get filled, and same thing, 75%. And this confirms James Altucher and Crowder's 70% rule, but that doesn't mean the trade strategy will work. Okay, just because you can win 70% of the time, the idea is how do you manage the risk? So you figured out a way to enter the trade, but now how do you not enter, say, one of these lower tier trades where you have a high probability to win, which is throwing off this average, and you want to be able to lose. But let's take a look at a real live example right now of something of a trading situation where this modified system, again, you can evolve the system as you continue and think of new ideas, and you can do this for any stock. Let's take a look here. So I have this check to trade enter little spreadsheet part, and again, you could run this through an algo if you knew how to program it to say if these conditions met. So let's take a look at today. I'm just going to slide over this particular screen here, and I'm looking at the SPY, and I'm just looking at this as my intraday weekly chart, and then I have an intraday 2-day chart, which could be useful for the gap plays, because that's all I care about is just the 2-day chart. But this intraday weekly chart can kind of give me a slightly broader view, since this is a day trader strategy. So I see that we've had a lot of gaps here. Like on this day, this thing gapped up. Then you had this Ukrainian news, and the market dipped down, and I made 15% just on the gap fill. I wasn't playing for the whole move down. I just play where the condition's true. I just want to hit the gap, because you can see by the end of the day is, look at that, it got filled. And then if you're trying to be stubborn and predict, hey, I'm going to just bag hold this winner or whatever, the next day the market opens higher, and now you would be at a loss if you would still hold that put. This is a trading strategy. This has nothing to do with being right. This has everything to do with, we're trying to make money here. We do not care what happens with the market. We just want to see, we're just playing the odds. I don't care if Putin invades Russia, which is kind of what set this off. I don't care about that. I just care about making money, because the rumor could be false, it could be true. It just doesn't matter. Who even knows why this gapped up? Nobody asks those questions, or why it gaps down. But if you follow the market a little bit, you can discern it. And again, you could add, if you feel like you want to add more of a fundamental case, you could add it. So here's a case where this market has gapped up and then up above the previous day high, and it has not fulfilled its gap down. So let's take a look at this particular tranche of this strategy. So I'm going to look at my spreadsheet, and let's just now narrow in on the 2-day chart here. The open for today was 196.85. The previous day high was this. The previous day low was this. So look at that. We have a gap up situation of 20 cents. And the 5-day ATR is 1.5, roughly. And then we have 20% is, that means I have a 20-cent move here as a sum. My percent to ATR move right there is 0.03. So that's my output. And now I can take a look at that tranche from the table I developed. So I'm going to go to, we've had a gap up, and our back here, our tranche is 0.13, which would be right in this tranche right here. So I'm looking right here in this area. So I have an 87% chance to win if I just play this from a pure gap fill. But there's more information than, like I said, that's why I'm filling in this information, because the market has significant gap up, but you can see that's sort of been met. On the average, you have a 0.43, and that's really where the market had gapped up about 0.5. The average to win is actually 0.8. Look familiar? Now the reason why it looks familiar is because it's exactly what's happened today, and we're at right now at 0.8. Now if you would have entered at the open, you would have been squeezed out a little bit. But we can actually look at the ATR average, which I go back to here, and I say, okay, I take the average range, and I take the open times the average range to the upside on a winning trade from the open. Let's take a look at this cell. That's correct. So I say I want to see the range up on this tranche, and then I say, okay, I'm looking at that, and I say, okay, well, that tranche is now, I times this by the opening value at 77 cents, and then I add it to the open, and I see it's 197.62. So we're not quite there yet. However, the market's up it's up almost a full percentage point, which you can construe that one of your conditions has been met, and that's why you do need to do an additional pivot on this data, in my opinion, because you can say, like, well, what are the odds? I want to do a pivot breakdown of the percentages. I want to say, okay, if this percentage is between this and this, what are my chance to win if this is the opening percentage here and here? So I can pivot that, and I can do a double pivot on this data with this condition of the range high to low. So again, most people they would want to play this as like, okay, it gapped up, I want to short it. That's fine, but I'm trying to develop a better strategy, because there's reasons why traders, this isn't just an easy money making strategy, and there's a little bit of the trader discretion in this, because you can blow up, easily blow up, because as you can enter this range, the further the gap away you are, the higher the odds that you're going to lose. And see, I don't even want to play these gap down trades, and this is something that the futures trader suggested, that you could just play for half of the gap, so you don't have to get fully greedy and fill that gap. And so what you could do is actually short it. I shorted right about here because it met this condition. Again, I shorted with a demo test position. So because I'm live testing this day, I want to live test this so I can really pay attention to what's happening with this data and see how the options market moves with this data or with this strategy. The rest of this I kind of explained in the blog post, but you can tell that this might not be a beginner strategy, and I'm analyzing the data, but for good reason, because this market is very, very liquid. There's a lot of scalability. A lot of market participants play in this particular market as well. This is probably a very good strategy to use, because I like it because I consider it a market neutral strategy. In other words, if you have a bear market, you're going to have a lot more gap downs, but as I've shown you, a high percentage, 80% of those gap downs will be filled. So the odds of you playing and buying this market could be applied. Think about in the future, just for a second, say that the SPY, if this starts to have problems, or like America enters a very cyclical bear market, or whatever the case may be, you could apply this to any other market, the Shanghai stock market, the Hong Kong stock market, the London Stock Exchange, your own market, whatever you want to do, or your own stock that you like. You could try to think about this gap situation and an idea to fill the gap situation. A lot of traders want to use discretion, and the idea is that you just minimize the risk. This is, we're trying to minimize the risk within the strategy. So instead of just shorting right here, where I'm only going to shoot for like 10 or 20 cent, at the 20-cent gap fill, and the gap has not been filled yet, because I do not want to enter that just right off the open. If I did, I could tranche in, say, for half of my normal position size, and then tranche in at the higher at where the average is struck. And now you can see the market has actually defined that. So you actually might have one of these 13% on the average days where this market actually does not fill the gap. And remember, the average move lower, here's the interesting thing, is remember the average move lower is actually lower. But you also have to consider the market environment that we're in. Like here, see, this is moving higher. The market condition that we're in is that we're in a very low volatility, low suppressed environment. So this market wants to move higher. So buying puts, as it stands right now, is not the greatest position. I don't care though about that so much. I just care because the odds are in my favor. All 4 times this has happened since it's been forward tested, so far have given 100% win rate. So like I said, you have a chance to make 70% of the time you have a chance to make money. So I'm just waiting for now for this little gap to get filled, but I've entered, instead of entering from here a high risk position, I've entered from here, which is a much higher, a better position. So my chance to get stopped out is somewhere way up here, which is not impossible, but I just shift the odds in my favor, and the market could even move down lower like it did on this day. Thank you for watching this video. I hope I explained this concept well to you. I'll probably make some additional videos as this strategy evolves, and I continue to add a few other sample strategies. If you're interested in investing at White Gem Capital, you can click the link to invest on the left-hand side and request information about the fund and determine if its risks are suitable for you. I hope you enjoyed this video. Thank you very much.